Modern economies are built on a simple expectation: growth. Every year, economies are expected to expand. Businesses aim to increase profits. Governments forecast rising tax revenues. Investors expect markets to climb over time. The entire financial architecture assumes that tomorrow will be larger than today. Growth is not just desirable, it has become essential. But this expectation raises an uncomfortable question. What happens when a system is designed in such a way that it cannot function without continuous expansion? To understand this, we must look at the foundations of the modern economic system. At the heart of it lies credit. Credit allows individuals to purchase homes, businesses to expand operations, and governments to finance infrastructure and public programs. Borrowing enables spending to occur today based on income expected in the future. In this way, credit pulls future demand into the present. This mechanism can stimulate rapid development. Entire industries can grow faster than they otherwise would. Innovation accelerates. Living standards rise. Yet credit also creates obligations. Every loan represents a promise of repayment with interest. That repayment requires income, productivity, and economic output in the future. When borrowing expands across households, corporations, and governments simultaneously, the system accumulates enormous future claims on economic activity. For those claims to remain manageable, the economy must keep growing. Growth allows debt to be serviced more easily. Rising incomes support repayments. Expanding output increases tax revenue. Asset prices appreciate, strengthening balance sheets. But if growth slows significantly, the structure begins to strain. Debt burdens become heavier relative to income. Governments struggle to balance budgets. Businesses face declining revenues while still carrying large obligations. Financial institutions confront rising credit risk. The system begins to depend even more on expansion to maintain stability. This dynamic creates what some economists call a growth imperative. The system is not merely designed to grow. It requires growth to remain stable. Consider the role of financial markets. Equity valuations often rely on expectations of future earnings growth. Pension funds depend on long-term investment returns to meet obligations. Government budgets assume expanding economic activity to support spending programs. Even labor markets are structured around growth expectations. New jobs are created as businesses expand. Without economic growth, job creation slows. Unemployment can rise. Political pressure builds for stimulus measures designed to restart expansion. Central banks play a critical role in sustaining this cycle. When economic growth slows, central banks often reduce interest rates to encourage borrowing and spending. Lower borrowing costs stimulate investment and consumption. Credit becomes more accessible, allowing economic activity to recover. During severe downturns, central banks may go further. They may purchase government bonds and other financial assets, injecting liquidity directly into the financial system. These actions are intended to support markets, stabilize credit flows, and restore confidence. In many cases, such interventions succeed. Economic contractions are softened, financial markets recover, growth resumes. Yet each intervention can also deepen the system's dependence on expansion. Lower interest rates encourage more borrowing. Asset prices rise, reinforcing expectations of continued growth. Governments may delay difficult fiscal adjustments if borrowing costs remain low. Over time, the global economy accumulates higher levels of debt and financial complexity. Growth remains the mechanism that keeps the system stable. Another important factor is demographic change. Population growth historically supported economic expansion. A growing workforce increases production capacity and consumption demand. Younger populations often drive housing markets, education sectors, and labor force participation. But in many advanced economies, demographics are shifting. Populations are aging. Birth rates are declining. The number of retirees relative to workers is increasing. These changes can slow the natural pace of economic growth. When slower demographic expansion meets a financial system built on continuous growth expectations, tension emerges. Productivity becomes increasingly important. Innovation, technology, and efficiency gains must compensate for slower workforce growth. Advances in automation, artificial intelligence, and digital infrastructure can raise productivity, enabling economies to generate more output with fewer workers. However, productivity improvements alone may not fully offset demographic and structural challenges. Environmental constraints also shape growth dynamics. Industrial expansion and resource consumption have historically driven economic development, but environmental sustainability has become a central concern. Governments and corporations are increasingly balancing economic growth with climate policies, energy transitions, and ecological preservation. These considerations may influence the pace and structure of future economic expansion. Despite these challenges, the growth imperative remains embedded within modern financial architecture. Debt obligations, pension systems, government budgets, and asset markets all rely on expanding economic activity. Without growth, difficult adjustments become unavoidable. Debt restructuring, fiscal reforms, and changes to financial systems may be required to maintain stability. History provides examples of economies adapting to slower growth environments. Some societies have shifted toward stability rather than expansion, focusing on efficiency, technological progress, and quality of life rather than pure output growth. Others have undergone periods of restructuring in which debt levels were reduced, financial systems were rebalanced, and new economic models emerged. The question facing the modern world is not whether growth will continue indefinitely. It is how the system will adapt if growth becomes slower, more volatile, or structurally different from the patterns of the past. A financial architecture built on expansion must eventually confront the limits of that expansion. Whether through innovation, policy reform, demographic shifts, or economic transformation, the future will require new approaches to sustaining stability. Understanding the growth imperative reveals a deeper truth about modern economies. Growth is not merely a goal. It is the engine that holds the entire structure together. And when an economic system becomes dependent on continuous expansion, its greatest strength can also become its greatest vulnerability. Welcome to Cash and Chronicles, where money, power, and history collide.